everyone, and welcome to lesson 25. Today we are going to look at a classified balance sheet. So it looks a little bit different from the balance sheet that we have seen in the past, but don't worry, we're going to go through it together. So with the new classified balance sheet, we have major categories. So as you can see, we have current assets, we have fixed assets, we have current liabilities, we have long-term liabilities, we have more included on our owner's equity section. Okay. And another really big difference is we have more columns. And instead of having our assets listed on our left side and our liabilities and owner's equity on the right side, we can see that we just have one column for all of our accounts. Okay, so we're going to go through what this means and why everything is circled in this way. So let's just start with the heading. Okay, so like our regular balance sheet that we've seen in the past, we have a 3-line heading with the name of the company, what type of financial statement it is, which in this case is a balance sheet, and our date. And again, just like what we've seen before, it's a specific date, it's a snapshot. Okay, now we first have our current assets. Okay, so our current assets are assets that will be converted into cash or used up during the next year. So bank, accounts receivable, those in this example are our current assets. Okay, now you can see that we have our 3 columns over here. Now the first column is the column we're going to use if we have to do any subtraction. The second column is where we are going to do our addition. And our third column is just going to have our totals. So in this case, we're adding bank and accounts receivable. We have that $sign in our first, as our first number there. And we have a single underline to show that we are adding these two numbers. So if I add my $4,850 and my $35,879, I get a total of $40,729. Because it is my first number, again, I will have a $sign. Then I list my fixed assets. This is also, or it can also be referred to as plant and equipment. So long-term assets held for their usefulness in producing goods or services. So in this case, we have our building. We need the building for producing our goods or services. So our fixed asset, we just have one in this case, is $143,420. It's just one. We're not adding more than one fixed asset. If we had more than one fixed asset, we would put it in the second column here to show the addition, but it's our final total, so we will put it in this column here. And so now I can add my current assets and my fixed assets together to get a total asset number of $184,149. Now, my next part are my current liabilities. Okay, my current liabilities are short-term debts, payment of which is expected to occur within 1 year of the date of the balance sheet. So again, accounts payable, those are short-term, usually paid within 30 days, and our HST payable and recoverable. Okay, so in this case, I'm going to take my accounts payable and put it in column number 2 here. And then because I'm subtracting my HST recoverable from my payable, I have to put it in my subtraction column. So I have $641 minus $279, which gives me a total value of $362. So I'm taking the tax that I have to pay, and I'm subtracting what the tax that's going to be paid to me, and I'm going to see the difference, and this is going to show my liability for tax. Now that I have both my accounts payable and my HST, I can add those two numbers together. So again, I'm putting those values into this column here because this is my addition column, and I'm going to have a single underline to show that I'm adding these two values for a total of $36,052 in current liabilities, sorry. Then we have our long-term liabilities, which includes debt of the business that are not due within 1 year. So because this bank loan specifically says 5 years, that's going to be long-term. And our mortgage payable, 20 years, that's also long-term. So we're not doing any subtraction here. We're going to add our bank loan and our mortgage payable to give us a total of $82,430. All right. Now we are looking at our owner's equity, and you can see that the owner's equity section is different. We have our capital, which is the owner's claims on the assets. This section is organized to show clearly the beginning balance, the increase or decrease through profit or loss, and the decrease through owner's withdrawals. And also, lastly, the ending capital. Okay, so in this case, our balance at the beginning of January 1st is $50,287. Our net income, which is found by taking our revenue minus our expenses, which again is found on our income statement, is in this case $37,880. Our drawing, so the amount that was taken out of the business for personal use, is $22,500. So if our net income is bigger than our drawings, we'll have an increase in capital. So in this case, 37,880 minus 22,500 is 15,380. Now, when I take that balance and add my increase in the capital, I will have a higher ending capital, which is in this case $65,667. Now, as you can see, my total assets are $184,149. They are also underlined, and you can't see on this example very well, but this should be a double underline. So for our totals, just like with a regular balance sheet that we've seen in the past, we want our final totals to be double underlined. So when I take my current liabilities and I add my long-term liabilities and I add my owner's equity, I should have a balance that matches my total assets. So this value and this value should be the same, and they should be in balance. So just remember that the inner columns, so these inner columns here, are used to list individual items building up to subtotals, and the two balancing totals, so the total assets and total liabilities plus owner's equity, are listed at the bottom. This information can also be found here. And what I went through when I was discussing the different parts can also be found on page 1 here. So this has the the differences between the classified balance sheet and the balance sheet that we have looked at in previous sections. Here is another visual to show the owner's equity and what happens. So in this case, the beginning capital is $10,000. We have a net income of $22,000. Our drawings, we have to subtract that because that's a decrease in our capital. So because net income is still greater than drawings, we have an increase of capital of $12,000. And when we add that to our beginning capital, we can see that we have a total or ending balance, ending capital of $22,000. Here is another visual of the columns. So column 1, we place sub calculations, usually needed for accounts that have contra accounts. In column 2, we place net account balances. And in the third column, we put subtotals and final totals. So the only thing that should be in this column here will be final totals. Okay, the first column is for subtraction, the second is for addition, and the third one is for finals. Now, lastly, the working capital is the difference between the current assets and the current liabilities. So you can find this by taking your current assets alone and subtracting your current liabilities, and this will give you your working capital.